So, Chance, I just want to pick up on something that you mentioned that I think is important to understand as it relates to regional banks failing. If if I've got my numbers right, I think there's about 4,000 regional banks in the United States. And then you've got your big money center banks like the Bank of America, JP Morgan, et cetera. And in Canada, we have 5 to 6 large banks. It's a very different system and very different versus everywhere else in the world, quite frankly. But you bring up a really interesting point, which is that the small banks in the United States do so much of the actual business lending and the commercial lending. And so if you're a lending officer at one of these small banks and you want to make sure you keep your job, what are you doing and what aren't you doing? You're probably not lending. So if you believe that that is the case, what does that really mean in terms of the economic impact? Because what happens in the United States has a trickle down effect to what happens in Canada. Like, does it really halt economic growth? Is what I'm asking.
We would say it does. So just to take a step back, these smaller banks, when you have a period of economic growth, everyone focuses on the mega cap businesses out there, but especially in the US, most of the new jobs that are added in the economy during a period of growth come from small businesses. And small businesses get most of their loans to try and finance their growth plans through the smaller banks. The smaller banks, the difference between them versus the JP Morgans and Bank of Americas of the world is that they have a higher loan to deposit ratio. So the customer deposits that they have at their bank, they're turning around and making a greater percentage of those deposits they're putting into loans, primarily towards small businesses. And with what's going on right now, where you're getting a 5% interest rate, you're seeing more customers at banks trying to pull those deposits and say, oh, I can get 5% somewhere else if you're not going to give me a 5% interest rate for what I've got with you at the bank. So because of that, some of these smaller banks are unsure what their deposit levels are going to stabilize at. And if they don't know what their deposit level is, they don't want to over lend and all of a sudden have more loans out than they have deposits. So they're really pulling back on their lending, but that means that there's a whole section of the business environment that's going to slow down because they're not able to get loans. And we hear stories from various people that Ted Oakley and I and others of our team speak to that just tell you anecdotally that this is happening in the last month or two. And you see that with some of the survey data that the tightening lending standards, both in the US and in Europe, are at levels you normally only see in recessions. So that's why, even though you've got the large cap stock indexes are still trading at higher levels, we would say that's a bit more of a mirage and we'd rather stay cautious.
Interesting. And just to add on that, what I find interesting as well that I've been thinking a lot about, as you say, a lot of people are taking their money out of the bank and putting it into something yielding 5% and something that has, someone on the risk-free rate side, plus a bit of risk. But even if you take a look at treasuries, if a lot of people have been moving their money into treasuries, my concern is that that's been such a trend trade that I'm concerned personally to do that trade because I think that the opposite could have an effect in terms of, I just think there's almost too much risk in that risk-free trade. Does that make sense?
Yeah, it's right to sort of consider if it's become too popular. One thing that we pay attention to, especially with longer term treasury bonds, so 10-year treasuries or 30-year treasuries that can move the market, is look at the speculative accounts where they're situated, if they're short long-term treasuries or if they're long in the long-term treasury bonds. And right now you actually are seeing the speculative accounts, which is sort of the non-commercial money, looking very short, which typically can drive bond prices higher and yields lower. Now, it depends on your time horizon. Right now, we're seeing some strength in the treasury bond market and yields are moving down. So while we've been buying treasury bonds for accounts over recent months, we might wait for a little bit of a short-term pullback before we add more. But we do think this trend, when you have more of a slowing economy and falling inflation, tends to be a good environment for treasury bonds. And so we think that trend will continue where yields move down. That's a separate question from the very long term, where we might be in an environment where long-term treasury yields might be moving higher in the years to come. But in this current environment with growth slowing, we would say to keep an eye out for yields continuing to move lower in the months or quarters to come.
Okay, and just before we wrap this segment,
Mhm.
do you think that the Fed will end up cutting rates this year, or is that a 2024 thing, or do they at all? Because Fed chair said basically they're not going to do it. I've got 7 seconds.
They could. We'll just have to see.
Okay, we'll take a quick break. We'll be right back.